is on entity selection and conducting your business and how it relates to succession. And we have Jim Awesome of Weston Hurd, a law firm up in Cleveland. Jim is one of the best in the business in this area, and we're pleased to have him here today. And I think at that point, Jim, I'm going to turn it over.
Thanks, Chris. Good morning, everyone. I did mean what I said. If you have questions, go ahead and fire them up in any fashion that you're comfortable with. And I will try to walk you through entity selection for the next 45 minutes. And I'm going to move to the next, I think the first substantive slide here. Corporations versus limited liability companies. They are clearly the most often used entities for business or tax purposes. And one of the key things to remember, because sometimes clients forget about this, is when you form an entity to conduct your business, you're doing that in order to shelter your personal assets from the general liabilities that you might incur in conducting a business. And as a jumping off point, let me just make one key element, and I'll do it in the form of a real-life story I had with a client. Obtained a new client a couple of years ago. He had an S-Corporation, very successful. Took a look at his balance sheet and realized that he had almost $3 million of cash in marketable securities on his balance sheet, and he was involved in the construction industry. And I said to him, why do you have all that cash in your balance sheet? He said, so that I'll have plenty of operating capital for bad times. And I said, well, part of the reason you formed an entity was to make sure that your personal assets were not exposed to the creditor's claims arising out of your business. And since you're an S-Corporation, you've already paid tax on virtually all of that cash that's still sitting inside your corporation. But if there's any kind of claim, your creditors will have access to that cash. Get it out of your corporation. You can always loan it back to your corporation personally or even contribute portions of it as equity if you need to. But why expose your personal assets, the cash that you have earned, that you have paid tax on as an S-Corporation, to your creditors' claims? So one of the things we do virtually every year when we sit down with our clients to do a review or do their corporate records, etc., is to review the balance sheet and make sure you're only retaining sufficient cash inside your entity to meet your normal business needs. I am pretty certain that this gentleman, he did take the cash out, as we had suggested to him. In some measure, he was doing this because he didn't want his spouse to realize how much money he had. But the essence of entity, use of entity, is to separate your personal affairs from your business affairs so that the two will not be interchanged for liability purposes. Now, in terms of corporations versus limited liability companies, it's pretty certain to me that the entities can be managed virtually the same way. For example, in a corporation, you have directors and officers. In a limited liability company, you have managers and you have members. Often the managers and the members are the same people. So it's really pick your poison how you ought to operate your business. And I have many limited liability companies that we have formed on behalf of clients that are operated for all intents and purposes as corporations, in the sense that we have the members who are tantamount to shareholders. The members elect a board of managers who are tantamount to a board of directors. And then the board of directors nominate a managing member or a managing director or even a president. They might even give them a corporate title. Quite often you'll see nowadays the term managing director or director, things of that nature for a limited liability company. Well, that's the equivalent of a vice president or an executive vice president, etc. Don't be misled by the nomenclature. It's all largely the same structure. Who has authority to conduct the affairs of the entity, etc. Now, both of these entities, whether it be a corporation or a limited liability company, can be managed pursuant to agreement. If you do not write an agreement, then you're going to be managed by the Ohio statutory law, or the Illinois statutory law, or the Delaware statutory law. Most of them are somewhat similar. Delaware's is probably as flexible as any in the country, which is why so many of the larger LLCs and corporations are actually formed in Delaware. But you can do it either way. Chairperson to James Awesome, I've heard one big difference is ability to distribute profits disproportionately in an LLC. Is that correct? Absolutely, positively, and I've got a slide and we're going to address that. And that is not necessarily a structural issue. That is driven by federal income tax law and what you can and what you can't do with an S corporation versus a limited liability company versus a C corporation. So the answer to that is absolutely, positively. All right, did I answer that question? I guess I did. All right, let's go on to the next.
Yeah, thank you very much.
Glad to do it. All right, creditors' rights. This goes back to my very first statement. One of the reasons you enter into an entity, or the formation of an entity to conduct your business, is to make sure you don't expose things, your personal assets, so to speak, to the vagaries of your business risk. Now, the significant difference between a LLC, a limited liability company, and a corporation when it comes to creditors' rights, which is theoretically an operational difference and a statutory difference, is that corporate law in virtually every state, and certainly in Ohio, states that the creditor may become the shareholder. If the creditor takes a judgment against a shareholder of a corporation, that creditor can actually become the shareholder and ask that those shares now be assigned to him or her, and they are therefore entitled to vote those shares. They are entitled to dividend distributions. They are entitled to make decisions regarding the liquidation, sale of the assets, etc. of the corporation. Just the opposite is the case statutorily in a limited liability company. The statute for limited liability companies in the state of Ohio, Delaware, and other places specifically states that a creditor, unless the other members agree, does not become a member of the limited liability company. The only thing they are entitled to is what is called a charging order. A charging order, which we're going to explain in some significant detail later on, gives them the right to the distributions that the member may be entitled to, but does not give them the right to vote, does not give them the right to participate in management, does not give them the right to demand distribution. They are only entitled to charge or claim the distribution that is otherwise made to the member. In a corporation, you can achieve something comparable to a restriction on the ability of creditors to become a member of a corporation, but you have to do it by agreement. It's not statutory. You would have to do it by agreement, for example, a close corporation agreement, wherein you would state that if there is an involuntary transfer of a shareholder's interest, and the classic involuntary transfer would be a domestic relations divorce court, if you will, ordering that one of the shareholders transfer half of his or her interest in the corporation to their soon-to-be ex-spouse. If you had a close corporation agreement that restricted involuntary transfers, you might be able to restrict that transfer, but you'd have to restrict that transfer in such a way as it still has economic substance. For example, the transfer could be prevented, but the economic benefit might not be prevented, in the sense that the individual soon-to-be ex-spouse would get other assets. So clearly, the limited liability company, as well as the limited partnership that we'll touch on very shortly, are much better creditor rights protection vehicles, if that's a concern, than is a corporation. I'm on slide 5, cost of formation. For all intents and purposes, in terms of the filing fees with the Secretary of State, whether it be in the state of Ohio or the state of Delaware, are essentially the same. There is no difference that would drive an individual to make a choice to use a corporation or a limited liability company based on statutory filing fees. Now, if you look at accounting expense and legal time expense and some of the other issues related to the formation of an entity, generally a limited liability company is going to be slightly more expensive. It's going to be slightly more expensive because it has a lot more flexibility than corporations. Because it has flexibility, it takes attorneys' time and perhaps accountants' time to sit down with you as the owners and determine what options you want to elect, both under the statute and also based upon your particular set of circumstances. So therefore, it's going to be perhaps a little more complicated. If you choose to take advantage of the close corporation statute in the state of Ohio, wherein you're basically saying, we're not going to follow the statutory law in Ohio. We're going to write a close corporation agreement that defines how we want to manage our relationships, how we want to determine distributions, how we want to make business decisions, how we want to be governed in terms of supermajority decisions, who can make the decision to sell the company or not sell the company. You could do that through a close corporation agreement. So that might be just as expensive, if you will, upon formation as would be a limited liability company. I have another question that popped up here. Is borrowing more complicated, expensive with an LLC versus a corporation? Generally not. The banks have come around to the point where they are very familiar with limited liability companies. It can be more complicated and more expensive. if you've not dotted the I's and crossed the T's. What I mean by that is a lot of people will form a limited liability company by filing articles of formation in Columbus and then not bother to write an operating agreement. The first thing the bank is going to request if you want to borrow money is a copy of the operating agreement. The operating agreement will define the relationship between the members. It will define who the manager or managers are. It will define who has the right to sign on behalf of the LLC, etc. So clearly you cannot borrow without an operating agreement. With a corporation, you would have standard things. But beyond that, it's the same thing then. And with a limited liability company like a corporation, you're going to make an attempt to borrow without personal liability, but it's certainly in today's climate, the bank is probably going to demand a personal guarantee of the members as they would of the shareholders of the corporation. I'm on slide 6, S-corporations. LLCs and S-corporations are both pass-through entities for federal and state law tax purposes, but they are not identical. And I can't emphasize that enough. There's a significant difference between S-corporations and LLCs for tax purposes as well as for operational purposes, and we'll go through that. S-corporations, first of all, have a limitation on the number of shareholders that can be in an S-corporation. I believe it's 100. When I first started practicing law, it was 10, and then it became 35, and then it became 75, and now it's up to 100. So an S-corporation certainly can have a significant number of shareholders to allow it to facilitate investments if that is what it's being used for, if that's the purpose of the entity. But a limited liability company has no restriction in terms of the number of members that can be in the limited liability company, and more importantly, who the members can be. For example, limited liability company members can be other limited liability companies. Limited liability company members can be S corporations, C corporations, trusts, estates, limited partnerships, foreign citizens, foreign entities. There is no statutory prohibition from a tax standpoint or from a local law standpoint as to who the members of a LLC are. So that's why the LLC from the get-go is a much more flexible device than is the S corporation. If you're looking to raise money in these terrible times, S corporation shareholders are limited to U.S. citizens and certain trusts, and therefore the access to foreign capital is almost precluded if, in fact, you're going to use an S corporation. One of the reasons we sometimes use limited liability companies. One of the things that should also be pointed out, I don't think it's on one of the slides, and I want to go ahead and make this point. Limited liability companies, upon formation, have to make a tax decision. There's something called check-the-box tax treatment of a limited liability company. If a limited liability company has at least 2 members, it may be taxed as either a partnership and file a Form 1065 United States Partnership Return of Income. It may be taxed as a corporation and file an 1120 U.S. corporation, commonly known as a C corporation, or it may be taxed as a small business corporation, which is known as an S corporation, and file Form 1120S. So a limited liability company, which has at least 2 members, may be taxed in any one of 3 ways. And theoretically, if it's owned by a couple other entities, it may be a disregarded entity. Now, if a limited liability company has only 1 member, which Ohio allows, Delaware allows, and most states now allow, obviously it cannot be taxed as a partnership, because to be taxed as a partnership you have to have at least 2 members. But it could be taxed, the individual could elect to be taxed as a C corporation or as an S corporation or as a sole proprietorship. And basically report the income and activity from that limited liability company on their personal 1040 as a Schedule C.
Excuse me, this is Bob Massengill. Is one tax form more popular than the other? Do you see most LLCs being taxed as flow-through partnerships or S-Corps versus regular corps?
Yes.
What are you generally seeing?
Well, generally, the check-the-box regulation means this. If you have 2 or more members of a limited liability company, the default is taxation as a partnership. So that's the default, and that is by far the majority of tax treatment for limited liability companies. S corporations have become reasonably popular. You don't see many C corporations for a lot of the reasons we're going to discuss because of the fact that C corporations become taxable entities unto themselves, and that kind of traps things inside. All right. S corporations and C corporations, one of the most significant differences is the capitalization of the entity. A C corporation or a limited liability company taxed as a partnership has virtually, literally, unlimited terms as to its capitalization. For example, a C corporation or a limited liability company can have different classes of units or shares of stock inside a C corporation, if you will. They can have convertible instruments, which were debt instruments that can be converted into equity instruments. They can have special classes of ownership interests, which may be entitled to preferential return before other distributions are made, etc. And I'm going to walk you through a couple of examples. An S corporation, by federal tax law, is limited to strictly voting and non-voting shares. That is a significant restriction on the ability to raise funds and do various things within the entity for purposes of the particular transaction a client or a group of business people may want to achieve. And literally, the two classes of stock rule at S corporation level can be a trap to the unwary. For example, a closed corporation agreement may have certain distribution options and other agreements inside the closed corporation agreement that effectively make the S corporation into a corporation with two classes of stock, and therefore you would blow the S election for tax purposes. So you have to be very, very careful. And more importantly, in S corporations, all distributions have to be proportionate. And proportionate means distributions are made in percentages based on the number of shares each person holds. So if I own 50 shares and my spouse owns 40 shares and my kids own 10, and the corporation made $100,000 last year, to distribute to myself $50,000, I have to distribute $10,000 to my kids and $40,000 to my spouse. I cannot make a distribution to myself and leave their shares inside the entity. The opposite is the situation with C corporations and limited liability companies. Let me give you a for instance. Client comes in, wants to develop some real estate, needs a financial partner. Client finds a financial partner. The financial partner puts up $1 million. The client's going to put up sweat equity. The client's going to build the building, going to find the tenant, do all the site improvements, etc. The money person wants a 13% return on their money. And once they get their 13% return plus all of their money back, then the deal will become a 50-50 deal or perhaps a 75-25 deal with my client getting 75%. So you cannot do that in an S corporation because that would be two classes of stock. That would be given a preferential return, which is a badge of two classes of stock to one of the investors. However, inside a limited liability company, you can go ahead and give that investor preferential units that state that virtually 100% of the cash flow, other than perhaps some stipend to my client as he's running the place, will be paid to that investor until he receives his $1 million back plus 13%. And at that point, then the deal flips. That is known as a special allocation under the Internal Revenue Code, under Section 700 of the Internal Revenue Code, which is the section that is used to tax partnerships. And that can be done also inside a C corporation, because you can have a preferential dividend and a preferential distribution on liquidation or sale to a preferred shareholder. But the trouble with a C corporation is that preferential return to the preferred shareholder is not going to be tax deductible to the corporation. It will come out as a non-tax deductible dividend. That has not been a very large impediment the last few years since the dividend rate was 15%. With a new president and a new Congress, I suspect the 15% dividend rate will go away, and that will become more of an impediment to using C corporations. The last point on the slide, item 7, that I want to address is the reason many people use S corporations versus limited liability companies is because a LLC taxed as a partnership the general presumption, although it is a rebuttable presumption, the general presumption under federal income tax law is that all earnings from an LLC taxed as a partnership are earned income, and therefore subject to self-employment tax, as well as, the unlimited Medicare tax. The unlimited Medicare tax being 2.9%. If you're an employee, you pay 1.45%, and your employer matches it. But if you're a partner, you pay the entire 2.9% on your entire distributable share of partnership earnings. If you're an S-Corporation, the concept would be that you would take out of the S-Corporation salary, because S-Corporations can pay salary to their owners, and that salary might be equivalent to the maximum Social Security amount, which this year is something around $100,000. And then the rest of the earnings that you would take out of that corporation would come out as S-Corporation distributions. S-Corporation distributions are not subject to self-employment tax, and therefore would not incur the Medicare tax, and would therefore, at a minimum, save the owner of the company 2.9% on whatever his or her earnings were in excess of the Social Security limit. Now, so professional service organizations, attorneys, accountants, architects, sometimes go ahead and form S-corporations to own their entities, with the idea being that they can take out a portion of their earnings and not have it be subject to self-employment tax or perhaps Medicare tax. The Internal Revenue Service is now aware of the fact that this particular technique has been discussed many, many times, and they're now examining it on a regular basis. Does somebody have a question? Okay. And so, although people are still doing this and are still using S-corporations in lieu of limited liability companies because of this particular quirk, I think it's going to become less viable in the future as the Internal Revenue Service will make it an issue for examination. And the general position of the Internal Revenue Service is, if the earnings do in fact come from personal services, as they clearly would in a law firm or an accounting firm, we don't care what you're going to call it. We're going to call it self-employment earnings and subject to Medicare tax. Now, I'm on page 8, and one of the general and limited partnerships have been very popular for 40 years. General limited partnerships, a lot of the tax law, and especially the estate tax law that deal with discounts and family business succession planning, deal with limited partnerships. The reason most of the case law deals with limited partnerships is because it takes anywhere from 5 to 10 years before a case works its way all the way through the federal system, all the way up to the Supreme Court, etc. So there are not many limited liability company cases that have yet worked their way up to be reported cases. We are virtually not doing limited partnerships any longer because we are simply using the limited liability company form instead of the limited partnership form because of the reason number 1 on my slide, number 8, and that is someone has to be personally liable. Under the Uniform Limited Partnership Act, the individual who is the general partner has personal unrestricted liability. So therefore, that's a bad result, and you can get the virtually identical tax treatment and flexibility that you want for estate planning purposes, income tax purposes, and capital formation purposes by using a limited liability company without having to create any personal liability on behalf of anyone. The only reason people still use some limited partnerships is because they are so tried and true, and nowadays, if they use them at all, they make the general partner a limited liability company or a corporation, so there is no general liability. The other points I want to make there is that with a limited partnership, yes, sir, no, that's someone calling me. Okay. If there is a limited partnership must have a limited partnership agreement. A general partnership can be a handshake between the individuals. The significant difference is this. If you have a general partnership which is handshake, and you do not have a partnership agreement, then you are equal partners. Even if one of the partners put up $1 million, the other one's put up 10 cents. You are equal partners. You need a partnership agreement to acknowledge those capital contributions and the proportionate ownership differences between the individuals. In a limited liability company, if you do not have a operator agreement, the default is to the capital accounts. So in a limited liability company, if you've not gotten around to using an operating agreement between the members, then the individual who's put up $1 million in my example, and the individual who's put up 10 cents, the individual who's put up $1 million will have a capital account, which means that everything will be allocated to that individual because there is no partnership, or excuse me, operating agreement that allocates any economic benefits to the sweat equity partner. On slide 9, we make some of those points I just talked about, and we talk about the fact that a assignee does not become a limited partner, which is similar to a limited liability company, and they get only a charging order. Limited liability companies, if you do not write a operating agreement, which is the second bullet point on slide 10, then the distributions, the tax recognition, all of the economic benefits, that bundle of tax and economic benefits that you realize as a member of a limited liability company are allocated according to your capital account. Therefore, it is essential, I think, that an operating agreement be crafted so that the parties realize between them what the equities will be and how much each will have. On slide 11, if there is no operating agreement, then in fact there is going to be the capital accounts. Throughout the Ohio Corporation Statute, throughout the Ohio Limited Liability Company Statute, and throughout the Ohio Uniform Limited Partnership Statute, it states that the statute provides X, Y, and Z unless otherwise provided in the agreement. Now, as a corporation, that means unless otherwise provided in a close corporation agreement. If you're a limited liability company, unless otherwise provided in the operating agreement, etc. My point being this: most of my business clients do not want the state of Ohio and its legislators writing their agreements for them. The statute does provide a framework for the conduct of the business, but you can override that framework by having a close corporation agreement or an operating agreement. So I want to emphasize with you, those of you who are business people, make sure that you've agreed upon the salient business points in your deal, and those salient business points are reduced to writing. On slide 12, I want to clear up something that I've heard said many times at seminars, and I want to make sure people understand that I think the contention is inaccurate. As we talked about earlier, a charging order gives a creditor of a limited liability company or a limited partnership the right to obtain a charging order. A charging order means that if there are distributions made by the limited liability company or the limited partnership to its members, then the distribution that would go to the member who has a judgment against them must go to their creditor. That makes perfect sense, and that's why it's often used as good leverage in family business transactions, so that if one of the kids gets divorced, dad or mom simply decides not to make any distributions, and that then thwarts the advantage to the soon-to-be ex-spouse because they don't control, nor does their spouse control the distributions, and it may be a way to give them a little leverage to go away. Some commentators go ahead and say that there's even more leverage than that, because they state that because these are pass-through entities, the member is going to be taxed on their proportionate share of the entity, the limited liability company's earnings. For example, if a limited liability company earns $1 million and your member has a 10% interest, their taxable income of that $1 million is $100,000. Now, if the managing member of the limited liability company determines not to make any distributions to that member, that $100,000 will still be taxable to that member. There are commentators out there that say that the charging order therefore means that that $100,000 of undistributed taxable income is taxable to the creditor. I don't believe that's true. I think that's contrary to what the tax law provides, because a charging order does not make the creditor an owner. A charging order does not give the creditor any rights of ownership or responsibilities of ownership. If there is cash distributed, they have the right to attach that cash, and if they receive that cash, they may have to pay income on it. But the phantom income of cash that is distributable to them, I don't believe is correct treatment, and I think the commentators who make that statement are not accurate. I'm on slide 13 where we talk about how a limited liability company is not by statute create any liability on its members. The members can only become liable on behalf of the limited liability company's affairs if they agree to. For example, go to the bank, you want to borrow money, and the bank insists that the members have to personally guarantee. Clearly, that will create personal liability. The other way that can be personal liability with the, let me go back to that one slide, with the limited liability company, as could be with a corporation as well, is if the creditor can pierce the corporate or limited liability company veil. And the way that is done is two ways. The first way is the alter ego theory. The alter ego theory is if the owner of the limited liability company or corporation disregards the formalities of the conduct of its business. For example, if the limited liability company owner pays his personal expenses out of the limited liability company's account, takes care of all his personal affairs out of the limited liability company account, disregards the legal existence of the limited liability company as it pertains to his own personal affairs or her personal affairs, then his or her creditors are entitled to do the same thing. If there's a business, the business does not pay your mortgage for you. A business does not pay your personal things for you. You take distributions from the business, put it into your personal checking account, then you pay those expenses yourself. If you skip that step, you're opening yourself up to the limited liability company or corporation having its creditor protection veil pierced. So one of the things you want to do is follow your lawyer and accountant's instructions, make sure you dot the I's and cross the T's, and keep your personal affairs separate from your business affairs. The other way it can be pierced is if the entity was set up with no capital whatsoever, is basically a dummy or sham entity, and did not have sufficient assets to conduct its business from day one. And then if that can be shown, and it's facts-driven, of course, then the creditor can also pierce the veil of the entity and get to the individual. Chris, how much time we have left?
Jim, we have about, depending on your watch, about 10 minutes or so.
All right, good. We'll get into then the step process, and if you have any questions, again, please feel free to go ahead and ask them, whether online or whether telephonically. The process, I think, is pretty easy. We know that you have the formation of an entity because you want to limit liability. That's why you do it. Then you have to decide what is the purpose of limiting that liability and the formation of that entity. And the first thing is ownership. Well, we already know, because we've gone through this process in the last 45 minutes or 25 minutes. If we're going to have more than 100 owners, we can't use an S-corporation. If we're going to have foreign corporations or limited liability companies, because this is a form of joint venture that's going to have a myriad of entities, we cannot use an S-corporation. If we are going to have special allocations, the example I gave you that an individual is going to put up the capital, another individual is going to put up the sweat equity, and we have to give the financial partner a preferential treatment on distributions and taxes and otherwise, we can't use an S-corporation. If we know that we don't want to trap the depreciation expenses that may come out of this because we have owners who may want to take advantage of those expenses, we probably don't want to use an entity that is taxable unto itself, a C-corporation. We probably want to use either an S-corporation or a limited liability company. So your first decision is, who's going to own this? How long are they going to own it? What's the purpose? And then that will perhaps absolutely positively drive your entity selection. The next one is tax implications. If we have to have special allocations, then we're going to either be a C, or we're going to be a limited liability company, or we're going to be a limited partnership. If, in fact, we are going to have income from personal services, and yet we perhaps want to be a little more aggressive and try to avoid the 2.9% of our earnings that would be subject to Medicare tax in excess of Social Security maximums, then perhaps we want to be an S-corporation. We can't use a limited liability company because a limited liability company, the presumption is all of our earnings would be subject to self-employment tax. Number 3, the purpose of the entity. Well, are we going to give sweat equity to someone? Then we probably can't use an S-corporation. Are we going to engage in personal services? Then perhaps we want to use an S-corporation. If we're involved in raising great deals of money, perhaps it's in a biomedical transaction where we're going to have to raise a lot of money in order to do the research and develop the product and then go to market with it, we probably are going to have to use a C-corporation so that the tax benefits are trapped, but eventually it gives us an avenue to go public and take those investors out. Plus, it makes it very easy to raise money inside a C-corporation because you have no restrictions on the number of investors or otherwise. Using tax advantages, well, clearly, you have to step back and say the entity is going to be taxed as either a corporation, and then if a corporation, either as a C or an S, or as a partnership, and perhaps it's a disregarded entity if it's a single member. And for state law purposes, that is driven 100% by federal tax law. What is going to be the tax treatment at the federal tax level, not the state level? The C corporation is a separate taxable entity. No longer in favor because it does pay taxes on its earnings, and if the shareholders want to take earnings out of the corporation, they pay tax on it again. If the corporation is ever sold, the corporation will incur a double tax because most entities who buy corporations and limited liability companies, for that matter, don't buy the entity, they buy the assets of the entity. And if the assets of the entity are owned by the entity, in this particular case a C corporation, the C corporation will have gained measured inside the C corporation by its basis in those assets, etc. Question, or you're alerting me at the time, Chris?
Neither.
Okay, all right, that's fine.
Okay.
And the biggest thing about C corporations is that if you have members of this transaction who are not going to be active in the business, you can't pay them a salary. You have to pay them dividends. And that's a very unattractive alternative, particularly in family businesses where you may have family members who are not active in the business, but for whatever reason they've inherited pieces and parts of it. You can't get money out to them on a very efficient basis because the only way you can pay it to them is as C corporation dividends. I know some accountants will sometimes get aggressive and, quote, put them on the payroll, unquote, but that is pretty aggressive. They're really not working, not rendering common law services to the entity. That may be approaching tax evasion. I'm on slide 18, S-corporation's pass-through entity. We've already talked about the fact that there's no double taxation. A S-corporation has a pass-through entity because it's not a taxpayer unto itself. When it sells its assets in an asset purchase transaction, there is no corporate level tax that has to be incurred. It's all incurred at the individual level. So if your intent is to build something up and then eventually sell it, you probably want to be an S-corporation or a limited liability company right from the formation stage so that you eliminate that first layer of tax at the entity level when the assets are sold. And that can put a lot more net dollars in you or your client's pocket. Partnerships, which is the same thing as a limited liability company, we can do the various things we talked about. We can do special allocations. We can have two classes of stock. We can have a very flexible equity structure. It really is advantageous. C corporations, if you're going to go public, it's the way to go. Beyond that, I don't use C corporations very often any longer. I'm on slide 20. Choice of entity continued. With C corporations, you can have a single level of tax, and there it is the use of a cash method. Partnerships over S corporations, I tick off there for you what I consider the advantages of a limited liability company over an S corporation. And clearly, I think that you can tell from my slide, and hopefully you can tell from the last 45 minutes or so, I think if you have to have an entity, a decision, the most flexible would be a limited liability company. Because if you form a limited liability company, you can then sit down within 30 or 60 days with your CPA and your attorney and decide whether you want your limited liability company to be taxed as a C corporation, to be taxed as an S corporation, or to be taxed as a partnership. So it is by far the most flexible. It clearly has advantages because a creditor can only get a charging order, which is not true with a corporation. So it has significant asset protection benefits that a corporation does not have, and yet it can have identical tax treatment to the corporation if you choose it to. If you want flexibility in your capital structure, or if you want flexibility in who is going to own your business entity, go a limited liability company. If you're going to have foreign investors, go a limited liability company. It is, by far, from my perspective, the most flexible entity. I've been speaking for, I think, 45 minutes, Chris. I'll be happy to take any questions.
I think we have a question here.
Yes, Jim, on selection on an LLC as far as tax filing basis, is it difficult or possible to change that at a future date should your circumstances change?
It's pretty easy to change. The only real restriction would be, once you can change a partnership to a corporation quite readily. All right? The trouble is, if you're a corporation and you switch to a partnership, that will be treated as a liquidation and sale of the corporation. So there'll be a tax event at the corporation level.
Okay.
If you form a limited liability, elect S-Corporation treatment, and then you decide, well, maybe we ought to be a C-Corp, that's easy. That's not a taxable event, but you then are limited. You cannot become an S-Corporation again for 5 years. The thing to be careful of, because the state of Ohio now allows 2-page conversions of entities from a corporation to a partnership, partnership to a corporation. Going from partnership to corporation is a non-taxable event. Going from a corporation to a partnership is a taxable event. I mean, you can do it mechanically, but there is a taxable event going from corp to partnership. The reverse is not true. Partnerships can liquidate themselves, give their assets to their partners, they contribute them to a corporation under Section 351, and it's not a taxable event.
Okay, Jim, we have a couple questions from the chat. I'm going to just read them out.
Sure.
One is, if you want to change the type of corporation, what is the look-back time that the IRS looks at?
When you say the look-back time to change, in other words, going from a C corporation to an S corporation, for example, if you started out as a C corporation, and then you decide, I want to sell my company in the next couple of years, and you switch to an S corporation, you can do that. The trouble is, at the time you make the election from C to S, you must have an appraisal done of your assets to determine the amount of what is called built-in gain that the IRS may subject your corporation to taxation over the next 10 years. Built-in gain is a function of, if you sold the assets on the day you elected S corporation treatment, the assets inside the C corporation have an adjusted tax basis, purchase cost less depreciation of, let's say, $1,000, and their fair market value on date of S corporation election is $5,000. The built-in gain is $4,000 on that asset, and that calculation would have to be made on all of the assets, and then that built-in gain would stick around for 10 years. If you've been an S corporation for 10 years or more, the built-in gain goes away. I hope that's responsive to what your question is.
Okay, I just sent a chat to the person to make sure that answered. The second question is, ESOPs have to be sponsored by regular corporations, I think?
No, I've got a client right now that is 100% owned by an ESOP, and it's an S-Corp. Yeah, the ESOPs can now own S corporations, and it can be a great vehicle because ESOPs are exempt taxpayers, so there is no entity-level tax whatsoever, nor is there any shareholder tax whatsoever, at least on the ESOPs portion.
Okay.
Maybe I can refine the question.
Okay.
When I meant regular corporations, I meant S or Cs. How would you sponsor an ESOP for an entity that's elected to be an LLC?
An LLC? I've never done one. I think the ESOP rules talk about corporations. I don't think they talk about limited liability companies. Now, if you had an LLC that is taxed as an S corporation, then you might be able to do it. I've never done it with an LLC. I think to be an ESOP, you have to be a corporation.
I think that might be correct, but I'm not sure either.
Sure.
Jim, I have a quick question of my own.
Sure.
Do you find that a lot of small business owners are a particular entity because that's the way they started and that's the way they've always been? And would you recommend them to, at a semi-regular basis or at least once or twice, to go and really take a look as to whether they are the right, in their current situation, whether they are the right type of entity for what they're doing currently? Yes.
Matter of fact, a lot of these guys formed their corporations in the 60s and the 70s, and at that time, by far, the majority of entities formed were C corporations. And they've just left it as a C corporation all these years. And we routinely review with them whether they should be a C corporation, and generally we have them switch to S. We have them get an appraisal, find what the assets are, etc. So yes, they remain almost by default what they started out as.
Okay. We also deal with a lot of quite small companies who are still sole proprietorships. What is your opinion on that type of situation?
No one should actually be a sole proprietorship, because a sole proprietorship is like being a general partner. You are 100% personally liable for everything that goes on inside. Well, there's no inside. That's the problem. For everything that goes on in your business. You can be a sole proprietorship for tax purposes and simply protect yourself from law purposes by becoming a limited liability company. If it's owned by one person, then that person can still file a Schedule C on their tax return, so they haven't changed their tax treatment at all, but they are at least insulated themselves from personal liability. If you're a sole proprietorship, which means by definition you are not any form of business entity, you have unlimited personal liability, and I don't know why you would want to do that, since you could now have a limited liability company, have the same tax treatment and the same uncomplicated tax life without the personal liability.
Okay, great, super. Anyone else have any additional questions? Okay, well, thank you, Jim. I want to thank you for that excellent presentation. A lot of technical material there explained quite well for us non-technical type people.
Good.
We appreciate that. And I want to remind folks that we have, as I mentioned at the beginning, we have an additional series of webinars coming up in a couple weeks, and then in early December as well. And you can check out our website for information on that.